Why are central banks around the world cutting interest rates? Why are central banks pumping liquidity, doing quantitative easing, and buying US treasuries as the Fed is doing? Why is this happening? Let's find out. Welcome back to Berich. Well, behind all the market screens that you see, there's a plumbing of financial architecture which keeps the markets humming. What we know, most of us know, is only the stock markets. But five times, six times the size of the stock market is the global currency trade and the global bond trade, which retail investors have no access to. All these markets require currency and liquidity. Also, most companies in the world to manage cash do not manage cash flow and pay salaries and short term expenses from their cash flow. What they do is they float what is known as commercial paper, which is basically short term borrowings for 30, 60, and 90 days and roll over these papers. Suppose I am paying payroll today, I am a large company, I may not have cash in the bank. I'll float a commercial paper, borrow the money, the bank subscribe, I borrow the money, pay the payroll, and roll it and pay back the money on due date. Most large companies in the world use these kind of techniques to meet their short-term expenses. What has happened after 2008 for the first time is banks are not willing to lend money. Nobody knows who has money and who does not have money. Companies have stopped paying commercial papers and are rushing to cash. They would have invested their money in other securities and floating short-term commercial paper to do interest arbitrage. What they are doing is they are now floating commercial paper and piling up on cash. This results in two things. One, there is no commercial paper demand, and two, there is sale of assets and flight to safety. Firms which have cash credit limits with banks are withdrawing the money fully and stocking up in other accounts in the fear that tomorrow these limits may be drawn. The only firms that are coming to the commercial paper markets are firms with very poor rating. What banks have done, since quality papers have dried up, banks are increasing rates of finance, making it difficult for weaker rated finance. Also, to meet regulatory requirements, overnight borrower, to meet regulatory requirements of keeping cash and meeting minimum bond requirements, banks do overnight purchases and sales. Banks lend to each other at practically zero cost or practically at the cost at which the Reserve Bank lends. These rates are going up, and there seems to be a divergence between worldwide between the rate at which central bank lends money to banks and the rate at which banks are willing to lend to each other. Currency trades are nearly about $2 trillion a day. These markets seems to have dried up. The safest currency is the US dollar. There is the US dollar which was freely available all over the world. As soon as news of the coronavirus has broken out, in the last 10 days, dollar availability has dried up and dollar is available only inside United States. And people are finding it difficult to execute even US Treasury trades because there's a shortage of trades as yields falls and the treasuries surge. This is why the Federal Reserve is now putting money into the market and trying to ease it out, and all other 14 other central bankers are trying to do something. The idea is not to stimulate the economy. The idea is to make sure that the arteries which do the plumbing behind the financial markets are free flowing. These are blocked, and the action of the Fed and other central bankers is not to stimulate the economy but to unclog the arteries and make sure that the blood of liquidity moves smoothly through the systems. Because if liquidity ceases up, most people panic, sell assets at whatever price they can, and move to cash and gold. There was a lot of profit taking in gold. Gold dropped from 1685 to 1500 as investors panicked. As soon as this Fed and the other central government has intervened, gold has started moving again. In terms of India, we can expect the rupee to weaken and the markets to continue to fall. India's growth prospects, which were already very poor, will take a big hit. We are not talking about the manufactured numbers put out by the government, but numbers indicated by the high frequency indicators, of which Arvind Subramaniam said are 17, are flashing red. There's an 80% drop in footfalls in car showrooms. Cars are not going to sell. Flights are empty. Hotels are empty. No tourism is taking place. Malls are empty. Theaters are shut down. And there is no economic activity in the major cities. In such a time, people are going to postpone purchase of consumer durables. This is certainly a bad time to be. Those who are having high debt and weak parents will struggle to survive. The only companies that are going to survive are companies which have zero debt and survive the next 18 months even if sales decline. Thank you for watching Be Rich. If you like this video, kindly share it among your friends and relatives. There is a WhatsApp number given below. If you would like to buy my book, please send your WhatsApp number to it and my team will get in touch with you. If you want to contact me, please send a mail to berichenglish@gmail.com and my team will get in touch with you at its earliest. Once again, I thank you for watching Be Rich.